Welcome back. Oil prices hovering near a 7-year low, down about 30% year to date. The energy ETFs are also feeling the pain from the fall in crude oil. The iShares S&P Global Energy Sector ETF down better than 20% year to date. Joining me right now is Mark Wiedman. He is iShares Global Head at BlackRock. Mark, it's great to see you.
Great pleasure to be here.
Thank you so much for joining us, because your business is indicative of really what the public is doing right now in terms of passive, in terms of investing in ETFs. What's your take on what you're seeing in terms of money moving in the energy space?
It's pretty clear.
Yeah.
China's down, commodities down, energy down, supply up. So money's moving out of the energy world, and the best place to track it is in ETFs.
Where is it going?
Well, it's going into two big places, and it has been all year, and frankly, I think it's going to happen next year as well. It's moving into European and Japanese and broader non-U.S. developed market equities, and it's moving into bond ETFs, and specifically non-government bonds. So it's moving into credit in particular in both the Europe and the U.S. And the reason is people want to get away from low yields and into higher yields.
I feel like we've been talking about this Europe story for a little while. A lot of money moving into Europe for some time. Is there any worry from your standpoint that maybe this is becoming a crowded trade?
You know, it's been over 23 years since somebody bet against a central bank and won. I would not bet against Mario Draghi. And our view is, if you bet with the European Central Bank, which is committed to inflating the European economy, you're probably going to have rising equities, and you're going to probably win.
It's all about central banks, Keith.
Yeah, you got to love that. I mean, I like to say to people, if you're going to buy the Japanese ETF, you have to absolutely understand that you're buying it because the economy sucks. So that's kind of like an interesting thing to pitch to people, which is, again, the economy sucks, so Japan's going to keep devaluing. And to your point, same thing in Europe. If you devalue your currency, that thing that's priced in that currency, which is asset prices, go up.
You know, I don't even think you have to see a devaluation of currency. I'm not so sure we're going to see the euro and the yen move. What we are going to see is an inflation in the equity prices in Europe and Japan. And that is the most reliable output of a stimulus, including negative rates, is that people borrow and they buy equities.
Yep.
And that's kind of what the ECB is trying to get us to do.
Well, they haven't just bought, I mean, one of the most successful, the best looking iShares chart is actually municipal bonds here domestically. I mean, people have said to themselves, you know, this equity story is kind of 5 years in. I'm going to put my money instead of underneath a mattress and buy MUB is the ticker on that. It's been fantastic.
Said that. You said bonds are also an attractive place.
Yeah, so I would say, actually, I want to be clear. When I say equities, I didn't say U.S. equities.
Right.
U.S. equities are basically flat for the year.
Yeah.
And we're not particularly bullish on next year because already they've been priced up. It's the Japanese and European equities that central banks have been popping up that we're looking into. Bonds, absolutely. So bond ETFs, whether they be credit, whether they be
Well, I was going to ask you about
ways.
the credit risk that people are taking. So you took risk to get yield in energy, and that smacked you in the face. And now you're chasing yield somewhere else. I mean, what kind of credit risk are they betting on in the bond ETF?
Great question. I think it's a question of a price. You know, if you look at the spread, the price effectively of credit in the U.S., high yield is now about 600 basis points, 6% higher than treasuries. That's actually a reasonable long-term number. It's not actually overbought. So now's not a bad time to be looking at high yield, to looking at shorter duration, lower interest rate risk credit, like CSJ is one of our products, that gives you like 1 to 3 year long-term credit. The real concern, I think, is about long-term interest rates, long-term duration for lower yielding investment grade product. And there you have the question of, like, we don't really know how that's going to react when the Fed raises rates. Let
me ask you about regulation and, of course, the Fed raising rates next week or in the next 2 weeks. Probably one of the biggest stories in asset management right now is this new fiduciary rule coming out of the Department of Labor. Explain it, and what's the impact to the business?
Okay. So the question that the Department of Labor is exploring is whether to impose what's called a fiduciary standard on financial advisors. And what that would mean is basically that when you're talking to a financial advisor, that he or she would have to meet the same standard that a lawyer, for example, would have to meet with you. Today they meet what's called a suitability standard, which is that the products they sell have to be suitable. The thought is that if the Department of Labor moves forward, they will shift the way that advisors get paid. And basically what will happen is that people will stop paying through commissions and through what are called retrocessions, which are payments made by asset managers to the financial advisor. And instead, it'll be all straight from the client directly to the financial advisor. And we see that happening around the world, the growth of what's called fee-based advice.
Right.
And as that happens, there's one iron law, which is that the advisors shift what they buy. They shift more towards cheap, efficient beta or passive products like ETFs, and they tend to sell a little bit less in the way of more expensive products.
Do you think that's important?
I think we're going to see We think that this shift, which is more likely than not to happen kind of globally and in the U.S., is going to accelerate the growth of ETFs because they're just efficient ways to build portfolios.
And real quick, are you surprised that the market seems to not worry about the terrorism stories that we're talking about every day? No reaction.
So it's interesting. I was just puzzling yesterday. Why is it the geopolitical risk has so little impact on market prices?
Right.
I think right now markets are focused on central banks and they're focused on the macroeconomy. And like, a kid with ADD who can't think about too many things at once, they're not focused on geopolitical risk, but it's the big uncertainty.
Wow. Mark, good to have you on the show today.
Terrific.
Thanks so much for joining us. Mark Wiedman, the head of BlackRock, joining us.